Okay, I'd like to begin the Finance Committee meeting for the month of June. Any public comments?
No, sir. No public speakers this morning.
Thank you.
This afternoon.
I need a motion to approve the minutes of May 23rd. Second?
Second.
All in favor? Any opposed? Committee work plan. I think we have one change.
There's one change to the work plan. The independent accounting review report of MTA financial statements for the 3-month period ending March 2011 will be presented next month and not this month.
Okay. Budget watch.
Budget watch. Okay. Overall results are tracking very close to budget on a year-to-date basis. I'll talk about revenues first. Those are actually down a bit. Subway revenue and Metro North revenue have been doing favorably, a little bit offset by reductions in bus revenue and Long Island Railroad passenger revenue. Down in total, we're down $11 million year-to-date, $2 million for the month. Toll revenue is doing a little bit worse than that. We're underperforming the budget each month. For the month, it was $3 million or 2.2% unfavorable. Year-to-date, those results were $9 million or 1.5% unfavorable. There we're being impacted by lower yield and lower traffic from the toll increase and higher fuel prices, we believe. In all likelihood, we will be reducing that forecast next month when we bring out the July financial plan. Going next to expenses, for the month we were almost flat. We were just very slightly unfavorable, $4 million, which reduced our year-to-date favorable variance to $41 million. And again, there we had some overspending early from the storms, and we have some higher energy costs, but net with the BRP and some other items, we're still running a little bit favorable in expenses. Debt service, we were unfavorable for the month and year-to-date. However, all of that was timing based upon when transactions hit the books, and we expect to be actually favorable year-to-date and even more favorable through the remainder of the year.
Excellent.
Yeah. Mm-hmm. Subsidies, PMT continues to come in right on target with the budget. The number's actually slightly low, but it's, again, that was all transaction timing based. We're actually right on target. PBT is running slightly favorable. Year-to-date collections are about $8 million or 2.5% favorable. Real estate taxes, we actually had a pretty good month. We had been running flat every month when compared with the budget. If you recall, we had a very good January based upon one large transaction. Since that time, we had been running pretty flat. For the month, though, of June, we're $6 million or 13.6 favorable, and year-to-date, these taxes are $25 million favorable. MTOA, again, we have those timing issues. We kind of know that we're going to be reduced 170 for the year, and there's timing in when we budget it and when we actually see it, but we know what those results are going to be. If you add up all these things, we're pretty much doing what we expected in aggregate. Any questions?
Any questions?
Can you go through? Can you add and subtract that again for me?
Well, we can do that, but you have some. What we do with Budget Watch, we always report the most recent month for each category. So we're slightly down in revenue, passenger and toll revenue. We're a little bit more favorable than that in expenses.
Right.
The debt service is unfavorable, but that's timing.
Okay.
So that goes away. The real estate is favorable. The PBT is favorable. The MTOA is unfavorable, but it's hard. Right now we're $30-some-odd million unfavorable on that, but that's kind of a fictitious number because that's based upon how we timed it for the month, when in reality it's whenever we get the money from the state. We know we're going to be down the 170 by the time the year is over. So if you were to take half of that, you could say, $85 million if you wanted to. But believe it or not,
it's really an irrelevant number anyway.
Yeah, if you add all of those things up, they come very close to zero, believe it or not.
So at the moment, I mean, we're as close to budgeted as we could be.
Well, yeah.
Well, let me phrase it this way. There are some people who believe that we are getting a substantial increase in real estate taxes at the moment. That
We-
is not, we are up 25.
17 of that was from one transaction in
Right.
January.
Right, but what,
Then we've been flat, and then this month, I believe we were 6 million
Right.
favorable. Yeah.
so the assumption being that even that, if that continued over that trend, we would still be a little up, but not substantially up beyond, the assumption being if it continues, not substantially up over the budgeted amount.
Yeah, we're looking at that. We're looking to reforecast that number right now, but I don't think it would be any windfall by any
Right,
means.
right.
Yep.
Okay.
That
Thank
is the argument that's being used to repeal the payroll mobility tax.
Right, that was one of the issues.
Yeah.
I'm not agreeing with it or disagreeing with
Right.
it, which is better. I'm just saying from a numerical standpoint, just looking at the number,
Yeah.
we're not seeing a substantial increase in real estate revenues as of now.
No.
What
That's
happens in the
correct.
future will happen in the future, but as of this date, we have not yet seen
We
that.
have not seen
Fine.
that at all. No.
Okay.
Just a quick question.
Sure.
Anything. How much do we expect from the new taxi tax they put on the livers?
We haven't calculated that yet. So
So there's no calculation in that at all?
we have not done anything. I don't know what has, anyone at the city may have done, but we haven't calculated that number yet.
Okay, thanks.
Any other questions?
That's a good question.
Okay, Finance
No,
Watch.
I just-
Finance.
on my
Pat?
tape. It was on my tape.
Okay, thanks. Finance Watch appears on Roman numeral 4-1 of your committee book this morning. I have a couple transactions to report. The first was a remarketing that closed on June 22nd. And this was a remarketing of $350 million of dedicated tax fund bonds that had been previously supported by a standby bond purchase agreement and insurance, and we by a bank called Dexia Credit Local. Dexia is no longer in the business of writing these types of agreements, and so we solicited for it and selected Morgan Stanley Bank and Bank of Tokyo Mitsubishi to provide LOCs on these bonds. We broke the transaction into two tranches, one tranche for each bank. Morgan Stanley will remarket the Morgan Stanley Bank bonds, and Goldman Sachs will remarket the Bank of Tokyo Mitsubishi bonds. We were very pleased. The initial rate set on these bonds was 9 basis points, so that was through the market index of SIFMA by 3 basis points on the day we remarketed. So we were very pleased with how that transaction started. This is a 3-year agreement, so in 3 years we'll be looking to renew or to do something else with these bonds at that time, and we'll keep you posted on that. The next transaction is one that we're seeking board authorization for this month, and that's just for $500 million of new money bonds that would be issued under the transportation revenue credit, and we expect to close that in mid-July. So we'll be happy to take questions on that. The other thing I want to point out that's not in here is we do have remarketing of some dedicated tax fund bonds that for liquidity facilities that are expiring in August, one from Lloyds Bank and the other from BNP Paribas, each of $100 million. Those banks have indicated that they're not going to renew their facilities, and so we'll be looking to come in with either a new bank or most likely we'll be putting a series of those bonds out into an index mode, and we'll report more on that in July. So unless there's any questions, that's all for
Do,
Finance Watch.
Do we need a motion on that new money issue?
It's coming up in the agenda, yep.
Okay, headquarters and all agency action items, what is it, Public Works and Planning?
Yeah, the first action item is the 2011 State Public Work Enforcement Fund, PWEF, assessment. We are asking the board to authorize a sum of $2,507,590, representing the 2011 assessment to be paid to the State Labor Department.
Any questions?
Can I ask a question? This is
Sure.
I know we have this one, and then we have the state that takes our money every time we put out a bond. Okay? Are these the only two situations, or are there others in which the state taxes us for doing our own thing?
There's another fee that we're charged along with certain other authorities, and it comes from the Division of Budget, where they go through and look at the costs that they have for providing supervision to various authorities, and they have criteria that they use to apply charges to them. And I believe that the charge for the year that just ended was $5 million.
Bob, could you give us a list next month as part of the July of all of the assessments in which the state gives us money and we give it back to them, basically for no good reason, depending on your point of view, so that we can have a better understanding of these type of assessments, because in reality, all we're doing with them is giving the state back money they gave us, which doesn't make a whole lot of sense.
Okay. Will do.
Thank you.
Okay, I need a motion.
Mark, is there anything, Mitch, is there anything that you think we'll be able to do with that information?
Well, I can only say that the legislature, many members of the legislature have been campaigning against the mobility tax, okay? And if you recall, they also just passed a quote-unquote lockbox for transit funds, although if you read it, it has lots of keys, but be that as it may, okay? And their point to us has been, we want to provide you with the funds that you need so that you can reduce, not cut services, not raise fares, and get rid of the mobility tax, which many of us would love to do, okay? So here's a situation where if the state would eliminate these three fees, and if those are the only three, they equal something, 10 million, 12 million, whatever Bob's number is, which we could go back to them and say, okay, here's a way you can start to do that by eliminating the fees you impose upon us for basically spending our own money to do what we're supposed to do in the first place. Right, and for which we get no services. So while by itself it may not be a substantial number, it is a number which is substantial enough to be of importance in the entire discussion.
And I certainly couldn't agree more. I raised the question just to ascertain in my own mind who the messenger would be. Who would pass that along to
I mean, obviously, many of us have communications with members of the state legislature. We communicate at length on them on MTA issues, financial and otherwise. And I think it behooves many of us to go back to the members of, our delegation, at least for me, the Long Island delegation, from others, in other places, to indicate to them, here's a situation you can help us with. This is a situation where, forget the fact that they took money last year, which they all take. In reality, that taking the money continues every year. These assessments are there, and we could use this money to restore a substantial amount or some portion of the services we had to cut. Just give back us the money you're taking from us.
I just would proffer that in my mind it would appear not to be inappropriate for the agency on behalf of the board to present such a case in a formal way rather than necessarily having it go through or in addition to whatever informal channels we can use. That's all.
Okay.
Okay, I need a motion. Second? Second. All in favor? Any opposed? Carried. Okay. Swap.
Yeah, next is Pat would like to talk about the swap novation.
Okay. This staff summary appears on 5-2 of your committee book, and this is seeking board authorization to enter into novation discussions with Citigroup Financial Products to move that swap over to a more highly rated counterparty. The change that I just talked about, the remarketing of the DTF 2008A bonds, did cause a couple of changes to the underlying swap on those bonds. Most notably, the insurer is being pulled out of that transaction. We went from an insured standby bond purchase agreement to a full letter of credit without the insurance being a bit of a problem for the banks. And so Citigroup is not obliged to get out of the transaction. We're not obliged to take them out, but they are very desirous to get out, and have proposed to us a fairly attractive novation agreement that's really costless to the MTA. We would essentially be moving our exposure to Citigroup to another more highly rated counterparty that's here on the list here before you. And we've identified a couple that we're going to start to talk to about this. For its part, Citigroup would essentially pay the credit costs, the hedging charges, and legal costs associated with moving that swap. So we're not on the hook for that money. And in the end, we're left with facing a more highly rated counterparty. And this is consistent with our commitment to the board to make sure that any changes we do in the swap portfolio would come before the committee and the board for approval. So I'm happy to take any questions about that.
Any questions regarding the swap? If not, can I get a motion?
So
Second?
moved.
Second? All in favor?
Aye.
Any opposed? Carried.
Okay.
I
Now-
assume this doesn't go into effect until we have somebody to substitute.
That's right. I mean, obviously, we'd have to come to terms with the new counterparty, whoever that would be.
Okay.
That's right.
Thank you.
Now we got the new revenue bonds.
Right. So turning the page to 5-4, there's a staff summary followed by a full supplemental resolution authorizing the issuance of up to $500 million of MTA transportation revenue bonds. This authorization is to fund existing approved capital projects for the transit and commuter systems and bus systems. What's contemplated at the moment is that we would issue approximately $400 million of these bonds in fixed rate mode, and then an additional $100 million in variable rate mode. This is a rotational assignment out of our underwriter pool, and it would go to Bank of America Merrill Lynch. They're first up here. The liquidity facility that's being put on the table is from Bank of America Merrill Lynch, and it came as a result of that solicitation we did last February. That their pricing remains valid, and it's a good way for us to keep some of our bonds in variable rate mode. That continues to be an attractive market for us, and so we're pleased that we think we can get there. But in any case, what's being authorized is the full 500, and in whichever form we can come to based on those kind of parameters I just laid out.
Any questions?
Are there specific revenues from that we're using to back the bonds?
These bonds are backed by a gross pledge of, meaning all revenues of the transit and commuter systems. So all the fare box revenues of transit, commuter, bus systems are pledged here, as well as residual dedicated taxes after they're used for dedicated tax bond purposes. As similarly, Triborough Bridge and Tunnel Authority surplus that comes over to the MTA would be eligible to pay these bondholders. So this is what we call our gross pledge credit. Essentially all available revenues are available to pay bondholders. The only revenues that really aren't in here are real estate taxes.
So therefore, we get a lot more of that than we're using for this.
Oh, the revenue is.
We would hope.
Right. So the revenue supports not only all the debt service on these bonds, but then of course it has to pay operations of the system.
So how do we decide which subsidies to use or which revenues to use to back a bond like this out of all of the possible options you have? How do we decide which ones to use or which ones not to use, the case may be?
No, it's a fair question. When we issue the bonds, we don't identify particular revenues from our revenue streams that are available. It's just all revenues become available, and essentially our debt service obligation is the first obligation that's met at the beginning of the month by our treasury operation. So typically that's going to be fare and toll revenue, but depending on timing, there might be an influx of dedicated taxes that have, once we've met the obligations on the dedicated tax fund credit, they could be applied. But there's no particular identification made to the bondholder. The bondholder receives the benefit of all revenues pledged under that indenture.
So, because the reason I'm asking the question is that, assuming for the moment the legislature changes one or more of the revenues we receive that has been, I don't want to use the word earmarked, because you clearly made a point that they're earmarked generically, not earmarked specifically.
Right.
How does that change, or changes which may or may not occur, affect the bond situation?
Well, no, it's again a very good question. Typically, what you're going to see is if the legislature makes a change either to the MTTF taxes or the MMTOA taxes, essentially those petroleum business taxes, sales taxes, and so forth, that's going to first impact the dedicated tax fund bond credit before it affects the transportation revenue credit. But the legislature reserves the right to make those changes. Mm-hmm. Now, typically what we've seen over the years is, they'll lower a tax here and increase a tax here,
right,
depending on whatever their broader priorities are. But that does happen.
But that would not. My only question: this action does not preclude them from taking that action if they want to.
No.
That was my only question. That was my question.
Sorry,
it does not preclude them from doing that if they want to do it. If they don't want to do it, nothing ever happens. But if they do want to do something within the range of what they could do, that does not impact either the payment of these bonds to the bondholders or the ability of the legislature to do what the legislature wants to do.
It still comes down to there's got to be sufficient funds
right,
overall to beat both debt service and to pay operating expenses, and that's what comes down.
And since debt service is paid first,
right,
as you clearly pointed out,
right,
the amount of debt service would be paid first by whatever revenues we had first, and then operations are paid after that, and the level, while the debt service payments cannot be changed, X is X, the operations payments could be changed, because operation payments go up and down depending on policy decisions made by the board and management in that regard. So those would be the ones which could be affected, not the debt payments under this scenario.
Correct.
Thank you, sir.
Excuse me.
No,
Sorry,
I'll
Mr.
yield
Chair.
to the new member. Go ahead. Welcome on board.
Thank you very much. What are these bonds rated, Pat?
These bonds are A2AA, transportation revenue.
Yeah.
So
And then the closing is in July?
closing is week of July 20th, I think, is what we identified, right?
Do you ever provide to the board the rating agency reports, or is that something we just talk to you about? Or?
Well, we're happy.
That might be
we're happy to
helpful.
provide that. Yeah.
Well, I get the reports like this. That doesn't assume they are there. But
A rookie question.
No.
Jonathan, you're asking a financial question. I'm asking a political question. They both coincide in this discussion.
No, we're not. It's a good question, John. We don't go to the rating agencies with a full report every time we issue bonds. Typically, we have update calls and so forth, because they're getting so much ongoing disclosure from us.
Right.
However, we have identified sort of after the July plan comes out, we're going to sit down with the rating agencies and really give them a real deep dive into the financial plan and everything, and we'd be happy to share that. Largely what we're going to present is what the board will be presented with at that time in July.
But they'll reaffirm the rating in the written format.
Absolutely. Sorry?
You provided that in the past.
Yes. Yeah, I think we have, Jim, yeah. So I think we'll be happy to bring that to the board.
Thanks.
Okay.
Thank you.
Alan?
Yeah, well, first of all, Jonathan, Doreen Frasca will text you and give you questions to ask at the meeting. And we'd be very happy if you would continue in the great role that you provided on this committee. So your addition is welcome.
All right, thank you. I guess.
The question I have in terms of this $500 million capital use, part of the first 2 years of the capital plan?
Exactly. It's part of the first
so
year
there's nothing in here that's anticipated beyond the end of this year?
No.
Okay, thank you.
Okay, I need a motion.
So move.
Second? All in favor?
Aye.
Any opposed? Carried.
Mr. Chairman, if I could just, there was one item that I didn't report in Finance Watch, and that's just on Friday, we executed an additional $10 million fuel hedge consistent with that board authorization that was granted earlier in the year. We saw a significant event in the commodities markets with the release of the strategic reserves, and it served to bring prices down. And so we had about 10 million in capacity, and we used that. We competitively bid the trade, and Bank of America Merrill Lynch won that. So I just wanted to report that, and that's for 12 months we're hedged to $10 million of ultra low sulfur diesel. At a price of $2.85 a gallon, and that's of all the hedges we've done, that's the lowest thus far. It effectively locks in a certainty on the loss relative to the budget that we're going to experience this year. So,
Okay, Metro North Railroad, Long Island Railroad procurement. I think we have one.
We have two headquarter procurements for a grand total of $155,970. We need a motion for that.
Page 5-18. Get a motion?
So move.
Second? All in favor? Any opposed? Carried.
Okay.
Okay.
Next, we have from the Metro North Long Island Committee, there's one competitive multi-agency procurement for Long Island Railroad with Metro North, New York City Transit, and MTA Bus for a grand total of $25 million.
Can I get a motion? Second?
Second.
All in favor?
Aye.
Opposed? Carried.
There are no procurements for MTA Bus operations. There are no procurements for B&T. Next item is New York City Transit. We have one multi-agency competitive procurement for New York City Transit with MTA Bus Company, Metro North, and Bridges and Tunnels for a grand total of $52,840,870.
Any questions? Need a motion? Second?
Second.
All in favor?
Aye.
Any opposed? Carried.
There are no items for the First Mutual Transportation Assurance Company. And I believe next on the agenda would be the real estate portion.
Thanks, Doug. Hi, everybody. We have 4 action items for requested board approval this month, each of which is the subject of a staff summary in the book. Be glad to take questions about any of them. If I may, I would just highlight 2 of them. The first is a proposed lease with renewal, extension with J. Crew downstairs in this building. As you know, as we announced a couple of months ago, we are intending to prepare to sell this building. Most of our leases here are in place and for longer term, and they all have 12-month demolition termination options in them. It happened that this particular lease was coming due, just as we were getting ready to announce the sale. Obviously, that's not optimal, so we were very pleased to be able to make this arrangement with J. Crew, where their rent is actually increasing significantly. There will not be a free rent period. Their fixtures in place are in good shape, so they'll only need to make limited improvements, and we will, again, as before, continue to have a termination right to accommodate a sale. As you know, we believe we're on a 2 to 3 year fuse to try to deliver vacant possession of this building, and consistent with that, and in order to provide the tenant with some assurances, we've agreed that if we were to terminate before the second anniversary, there would be, in effect, some recovery by them of some of the money they're paying us. But any way you slice it, it's an improvement over the status quo. So we're very happy with that outcome. Second thing is an effort on our part to address a kind of a structural deficiency that we've had for some while. It's been a source of concern to me ever since I got here in our existing 3 contracts with 2 contractors, CBS and Van Wagner. Each of them essentially is on a plus or minus some details is in a common form, which entails the contractor selling space in an existing inventory of frames and equipment locations, and remitting a specified percentage of those gross revenues to us against a minimum annual guarantee. In the case of the CBS transit contracts and Van Wagner, it's 65%. In the case of the new contract with CBS that we brought to you last year in the wake of the Titan default, it's 70%. But in any case, the salient point here is that each of them has roughly 5 years left to go, and provides for the possibility of additional investment by the contractor to create, new locations, new opportunities to generate new income, but no obligation on their part to do that. And particularly as we've talked about trying to move to the next, to the I don't know if it's the next generation of advertising, but to the future of advertising and digital, there's significant capital expenditures that are entailed in doing that. There's clearly money there, but there's business risk associated with those substantial investments, and it's very problematical, to say the least, to expect the contractor to try to recoup that money only through, their profit margin on their, say, 35% or 30% of the revenues. So what we've agreed, with your permission, I'm asking your authorization, is to allow me in selected cases to induce contractors to make appropriate investments to put to put new equipment in place, that we alter the waterfall, if you will, under the contract, so that the first use of the net incremental revenue from those investments, net of direct operating expenses associated with those ad sales, would be applied to recouping of the capital expenditure by the contractor with a 10% return, and then we revert to the regular revenue share. We project that this should result in very significant returns to the MTA during the remaining lives of the contract. We're looking at, depending on the nature of the investment, some of the things we're looking at, a 1 to 2 year payback is anticipated, and so we think there'll be good money for us as soon as that happens. And beyond that, particularly in the case of some things we're talking to CBS about with respect to the urban panels, we think there's opportunities for us to do some very exciting things related to agency messaging. The next generation digital screens will be independently addressable. We'll be able to send specific messages to specific locations, and we will have the right to do that under the CBS contract. So I think this is win-win, and what we're doing in effect is eliminating a kind of a roadblock to making that sort of progress. I would ask for your authorization.
Any questions?
Enthusiastic motion.
Motion made.
Thanks, Jim.
Can I, second?
Second.
All in favor?
Aye.
Opposed? Carried.
Thank you.
Okay, motion. Our next meeting is Monday, July 25th, 12:30. Motion to adjourn.
He told you the